Everyone is looking at the top line. Everyone is celebrating the $57 billion in revenue. If you just read the press release, Nvidia looks invincible. But I don't read press releases. I read the footnotes. And for the first time in a long time, the math in Nvidia's Q3 earnings is starting to look messy. There is an $8 billion hole between their profit and their actual cash. The inventory is piling up faster than sales. Today, we are ignoring the hype. We are going to look at the three ghosts in the machine: the revenue quality, the cash flow divergence, and the receivables problem. Let's dive in. Is there water in the numbers? First question: is the revenue real, or is there water in it? Officially? No fraud. The chips are shipping. But here is the dirty little secret of this bull run: concentration risk. Over 40% of this revenue comes from just 4 companies: Microsoft, Google, Meta, Amazon. Think about it. This isn't a broad market adoption yet. This is a capex war between 4 billionaires who are terrified of missing out. There's a theory circulating on the street called round tripping. Big tech invests in AI startups. Startups buy Nvidia chips. Money goes back to Nvidia. Is it illegal? No. Is it sustainable? That's the trillion-dollar question. If the AI returns don't show up soon, these 4 clients will close their wallets. And if they do, Nvidia doesn't just slow down, it crashes. Would cash flow and inventory be a problem? But here is what really caught my eye. Nvidia reported $31.9 billion in net income. Incredible margins. But look at operating cash flow. Only $23.8 billion. That is an $8 billion divergence. In a healthy business, cash flow should be higher than net income because of depreciation. Here, it's lower. Much lower. Where is the money? It's being sucked up by working capital. Visual. Bar chart showing inventory jumping from $15 billion to nearly $20 billion. Look at inventory. It spiked 32% quarter over quarter. Revenue only grew 22%. When inventory grows faster than sales, that is a classic bearish signal. Now bulls will say they are just prepping for the Blackwell launch. Maybe. But bears will say this is the start of a glut. If Blackwell faces any delays, that $20 billion of inventory becomes a massive liability. The DSO mystery. Why aren't they getting paid? Finally, let's talk about Days Sales Outstanding, or DSO. Basically, how long does it take for Nvidia to actually get paid after shipping the chips? A year ago, it was 41 days. Now, it's hovering around 53 days. Why is the payment cycle getting longer? 2 reasons. 1. Back-end loaded quarters. Because of supply constraints at TSMC, Nvidia is rushing shipments out in the very last weeks of the quarter. They book the revenue, but the check hasn't cleared yet. 2. The client power dynamic. When your customers are trillion-dollar tech giants, they dictate the payment terms, not you. Nvidia is effectively acting as a bank right now, floating billions of dollars to its customers. So, is Nvidia cooking the books? No. But are they feeling the growth pains of a company moving too fast? Absolutely. The profit is amazing, but the cash conversion is lagging. The inventory is building up. The customers are taking longer to pay. As an investor, stop obsessing over the P/E ratio. Watch the cash flow. If that gap widens next quarter, it means the perfect game is over. Stay safe out there. Don't forget to subscribe for real analysis.